Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. We're sponsored by McClure Capital. Coming to you from our corporate headquarters located at the Star, the Dallas Cowboys headquarters. I'm Guy Allard.
And I'm Victor McClure.
We've got a good show for you today. We're going to talk about the economy. A lot of things are happening, a lot of reports. As the bumper said at the beginning of the show was put together to kind of take the mystery out of the stock market, explain terms and things that you may not be familiar with, and just kind of break it down to common sense logic. Right, Victor?
That's right.
You're being awful quiet over there.
We're reversing roles today. So Guy's taking over the helm of the show today, and I'm going to answer questions the best I can. By the way, we've been doing this each for 30 years.
That's right.
When I was younger in this business, I never mentioned, experience. And luckily back then, everything was done on the phone. Because I remember a client met me when I think I was 35. I'd already been in the business like 10 years or whatever. And he goes, "Holy crap, I didn't know how young you were." I was like, "Woo, you should have seen me 10 years ago." But now that we're old geezers, it's perfectly fine.
That's right. And whether you're a client or a potential client, we've got a lot of good things planned this year. We met, some business consultants that we work with took us out to dinner here at the Star Tuesday night, and we were putting the plans together for the year, like I said, for our clients and for potential clients. We're working on doing some client appreciation dinners and events and gatherings, and we'll certainly do a few of those here at the Star.
That's right.
Like to have maybe some Cowboys, maybe Bob Lilly, someone that he might be.
Jerry Jones, I'm sure will stop by.
Oh,
right?
Well, he shakes all of our investors' hands and says, "What a wise decision you've made."
Still got that Johnny Walker Blue in my office.
You're waiting for him to stop by?
Yeah, he hasn't stopped by yet.
That's exactly right.
I'm still hoping.
But anyway, it'll be fun. We like to make it fun for our clients, and for the potential clients, we can take some pictures with the Super Bowl trophies, with the Super Bowl rings.
That's right. And if you're not a Dallas Cowboy fan, you're really not a true American. So.
That's right. And if you're not a Dallas Cowboy fan,
you're welcome to.
All the events won't be here, but we'd like to start off here. Anything else, current topics, before we get into some things you'd like to discuss?
No, the market volatility has been, I said this a few years ago. I said, I've never seen the market this volatile, but now it's even more volatile. I mean, this thing's moving 3 or 4% a day, but it's ended up where it's got a, loss for the year. It was a pretty bad loss until this week it rebounded from last week. I mean,
crazy.
It is, I've never seen anything move 3, 4, 5% a day. Now, there's nothing wrong if you have that kind of risk tolerance. It doesn't bother you, but what it does do a lot of times, it reminds us that if you have some planning to do, income planning, your bucket strategies, that it might be a good time to do those. Remember, we talked about in last week's show, when the Shiller PE ratio reaches 30. It's reached 30 several times in history. It went way above 30, like in the late 90s and then the mid-2000s. The problem is, the preceding 15 years, the best return you've ever received ever is about 2.2 or 2.4% per year.
That's right.
What I'm saying, we said the reason why, if you think logically, it's 30 means it takes 30 years to get your money back if you purchase this company with cash. And that means that's the S&P 500, which 99% of every portfolio in the world has a lot of S&P 500 in it, because it's not all your big, but most of your big companies are in there. The ones that aren't on there, some of the tech companies, they're still in the NASDAQ, stuff like that. But I'm telling you, almost everybody owns the S&P. It's a much better gauge than the Dow. Dow Jones is 30 industrial stocks. Now, they've updated it over the years, but it was pretty much industrial stocks. We're not that much of an industrial nation anymore. We're more of a technology nation. The American companies, the reason why they are so dominant in the world, well, I know Al Gore said he invented the internet. But
yeah, but it's questionable.
American companies invented the internet, the routers,
right?
Everything. The computer, the microchip, done by TI right here, right?
Absolutely.
All of those different things. So that's why. But everybody else is catching up.
The problem that we see, and we see it a little clearer from this side of the table at times, last year kind of numbs you to the fact that the market is volatile. Because what happened every single month, it went up. And we'll talk about it a little bit more in depth as we get into the economy throughout the show. But if you remember last year, no matter what happened, no matter how bad it was, the sky is falling. The market, how did it respond?
It just went up.
It went up.
Kept going up.
It was crazy. But the show is put together, again, to answer your questions, make things simple, kind of take the mystery out of things. So if you have any questions, if there's some things that you'd like for us to cover, our phone number is 972-715-2424. Or you can go to our website, ilovemyretirement.com, and you can also catch past shows if you'd like. We've got the titles, kind of give you an idea what we're going through now and getting that a little bit more organized, the podcast. There's a rumor, and it is a rumor, but trying to work out a deal, and perhaps we'll be coming back on KRLD.
Yep, we're working with them right now.
Working with them right now. We enjoy doing the podcast, but we just don't reach the same audience as we did on KRLD.
Yeah, somebody asked me, why do you call it ilovemyretirement.com? Is that just a marketing stick?
Right.
And I go, no, it's a good marketing stick, but the truth is when you get your portfolio done correctly,
right,
when you have your income needs met for the rest of your life no matter what, you have enough for liquidity, and you have enough for growth. Their stock market is a key component. You don't have to have it if you're just that not risk tolerant, right? But it's a really key component because it's the only part of the thing that consistently over time has beaten inflation. And so you need all of these components. When you have them all in place, and you won't worry about the market taking a dip because you know your bills are paid every month no matter what. When you have that kind of life in retirement, that's when you'll love your retirement.
Well, I tell you what, I was going to save this for a little bit later in the show and get into the economy and all that great stuff and explain the front end of the yield curve. But since you brought that up, I had a phone call just the other day from a client of mine. Sharp guy, he's an IT guy. He's 69 now, thinking about taking his Social Security at 70, right? Because at 70 you get the final raise. He doesn't increase after that. And he did a fixed income annuity for additional income with non-qualified money, not with qualified money, to increase what he would get in retirement. And he started, I think, back in 2014. So it hasn't even been that long. So the point here is if you think, I don't have enough time, I can't build up enough income, that may not be the case.
So he's like 66, and now he's 69, something
69,
like that.
and he doesn't know if he's going to start this income at 70 because it's non-qualified. If it was an IRA, we always talk about IRAs work hand in glove because what is an IRA when you turn 70 and a half? It's a forced income stream. You have to take your required minimum withdrawals, and obviously you want to take as much as you can. Now, this was a smaller account. It started with about $230,000, like I said, June of 2014. Been with us a few years, and if you think about it, with the interest rates being where they are, you could getting 2% on your money. How much can you take out on $200,000? $230,000.
Yeah, 2.8% is a fair withdrawal.
Is a fair withdrawal. At age 70, if he wants, his guaranteed income value on the account on the $230,000 would increase, and this is a guaranteed number, it's not a could be, will have increased to $350,000 from $230,000, roughly 4 or 5 years. His income that he can withdraw now would be, for a single payout, for his life only, would be about $21,000 a year.
Put that in perspective. Put in what, 230?
Yep.
Gets $21,000 a year in income for life.
That's 10% darn near.
Yeah, that's why I've always told you the reason why annuities, you got to stay away from all high fee annuities. All of them are bad. But you go to a low fee annuity is because there's nothing else going to produce that much income. So you can take the $230,000 to produce the $21,000 a year, or you can take about $900,000.
That's right.
That's what it would take to produce it. If you've got a sequence of returns risk, like you're taking it from dividends or something in the market, it would take $900,000 to produce that same income. So the reason why we're proponents of annuities, not just kind of we're annuity lovers, it's just I can take $230,000 and give the same income needs as somebody for $900,000. Now that I have that, I can put a couple $100,000 of that in cash or something for short term.
That's right.
I can have $500,000 or $600,000 in stocks to give me the real growth potential, and I'm getting the same income that I would have got at $900,000, but I'm fully diversified and I have a whole lot of growth potential.
And the money that you've got in stocks is not shouldered with the burden of having to meet your income needs. And what I mean by that is you look at the volatility of the market right now. If the market went down 10% in a month, which is certainly probable nowadays,
Right.
and you've got to take your withdrawal, you've taken it at the bottom. You can't take your withdrawals from a flexible income or rate yielding
Principal
vehicle.
moving.
Yeah.
Because what happens is if it drops, think about it. If you're taking out 5%, but the market drops 50, you just took out 55%.
Yeah.
Of your principal. If you take out 55% of your principal,
Need over 100 to come
it's
back.
called the death spiral.
That's right.
It is impossible to come back. If you make 15, 20% a year, 4 or 5 years in a row, you still will not have anywhere close to your principal. So the next downturn, the next term, it doesn't make 15, 20%, you're going to be eating in that because you still need that 5% or that 50 grand a year. So I don't care if the account value is worth $1 million or 300,000. You need 50 to pay the bills.
That's right.
And that's why not take 400 from the original million, cover that 50 no matter what, you can have that 600 in the market. So when these fluctuations, you don't have to sell.
And that helps protect your other funds. It
That's
allows them, and it enhances your portfolio. Now, in fairness, let me where I'm going with this, I'm taking a long way around the bush, about $21,000 for single life, but he's married. So on a married, and it's a joint life, so either person gets it forever. The amount's about $16,000. So there's a difference.
Is the wife younger?
A lot younger.
That's why.
Yeah, his wife's like 15 years younger.
Normally, there's not that drastic.
Good catch.
Right? Normally, it's 21, and the other one will get 19 or 18. The wife is a lot younger, so when you do a joint life, they don't care about the oldest person anymore.
That's right.
Because it's all
always the
actually
youngest. That's right.
The youngest person has the longest lifespan. So, but even then, $16,000 a year guaranteed on 200 invested. It's still a crazy amount.
Right.
And his wife might have a 30, 40-year life expectancy. And I'm telling you, you have no idea how long you're going to live. Both my parents died around 70. Both of them. Does that mean I'm going to die around 70? I certainly hope not. Things are different now. Both my parents smoked, 3 packs a day. That was in back in the 60s, right? They all smoked. Nobody ever worked out, never heard of working out. It just didn't happen. And so we live healthier now and all that stuff, but I just say this, I'll probably croak on the way home today.
It's the healthy ones that always go first.
That's right.
But again, where I was going with this, Victor kind of jarred my memory. We're talking about the website, ilovemyretirement.com. Very sharp guys. I'm sure he's a Mensa guy. Deep questions, you could tell. In the stock market, had some other things going on, even had a variable annuity, which actually is where these funds came. We were able to reduce the rates, guarantee the number. It didn't have market.
Get rid of those fees or reduce the fees.
And fluctuation. But he called me up, and we were just talking about it and going through the plans, and he said, this was really surprising to me. And I said, yeah. He goes, I was a little questioned at first. I wasn't for sure. How you're always apprehensive because you're doing something new, and you hear the Fisher ads or whatever, and everyone tells you, thinking of variable annuities, that it's not the best. And I said, you know what? This probably has outperformed anything else you have. And he thought about it for a second, and he said, yeah, I think it has. Now think about it. This was guaranteed at 7. The new ones are guaranteed at 6% growth. Some of them, not all of them, some of them used for income. And we've talked about it for the last 18 years. The market with dividends, if you could find a place to invest where you didn't pay any fees, was about 4.9 now with this last year?
5.27.
Okay, bumped up. 5.27. Here's a guaranteed 6. Well, why don't I put all my money there if that's guaranteed 6 and the market's only done 5.27 for the last 18 years? Well, you can't put all of your money anywhere. It doesn't make sense. You've got to have an inflation hedge. You have to have the cash bucket for liquidity and expenses and emergencies. We've talked about it. But these work. A couple of really good points I hope that you can kind of garner from this. One, it didn't have to be in there for 10 years or 15 years for him to meet his goals. It was 3 or 4 years. This particular client was a lot of money to him, and it certainly is a lot of money, but it's not, you don't have to have $2 million to do it. If you can do $2 million, obviously you've got a great retirement. It doesn't take a lot of money. It doesn't take a lot of time if you're efficient and effective with what you're doing, and that's where Victor and I excel. We all day long, all week, all we do is look at our clients' portfolios or potential clients' portfolios, and we go through and we stress test them. You've heard us talk about it. We look for the areas where the weakest link sort of thing breaks the chain. Where is there an issue? You can look at the taxes through your retirement. And most people, quite frankly, and it's human nature, end up with too much at risk just because either the market's doing real well or they're trying to play catch up. And those are areas where we can really help them.
I've got a couple examples of, I had a client that had a variable annuity. You know, we don't recommend variable annuities because it's very hard to
find. And there are some that are
fee.
Good, right?
Yeah, you got TIAA, CREF, and
right.
Vanguard, pretty low fees for a variable. Those aren't bad. You just get no help, but that's okay. They're not bad. All the rest of them are terrible. But what I want to do is, he said, I think I've already got this handled. I like the way you talk on the radio, blah, blah, blah. And I said, well, let me just look at it. So we looked at it, and I said, okay, it's not bad. The problem is the account balance wasn't as high as his income value, right? So he had a higher income than he normally could get off of that money. So I said, all right, let me run some analysis. So we ran a test against like other types of annuities as far as income goes. What we were able to accomplish was get him 28% more income.
Wow. And
he lowered his fees 75%. He was paying 4% in fees, and we got it down to 1% in fees. I've seen other ones where we got it down to 0% fees. And so 28%, so they already thought they had it handled, but who wouldn't like 28% more income for the same exact money?
Right.
And lowered their fees by 0.75. And some people don't care about the fees.
Well, this is available,
I do.
Victor. How come my current advisor didn't show me that?
Well, a lot of times they didn't offer it. Like all your big firms,
That's
when
right.
the index annuities came out, they've been selling variable annuities for 50 years. And they said, oh, those are no good. Every single one of those firms
that didn't
sells them now.
Right.
Because they understand, because all the negatives they were saying weren't accurate. They were just selling you something else. But now that that's come out, variable annuity sales have tumbled. I mean, skyrocketed downward. And index annuities have skyrocketed the other way, because the main thing is, if I can get more income for less fees, that's what I want to do. And so we can do things like that. Another client came in, and they had a pension offer. All right, they were 60 but retired at 65, but they said at 65 you'll get this much income. And I said, don't look at the different ones, just look at single life and joint life, because unless you don't like your husband or wife anymore, you're probably going to want joint life.
That's right.
There's no way to tell which one's going to die. Women typically live longer, but I've got, like, my wife's grandfather. He lived 15 years longer than his wife, and he had like 7 bypass surgeries before she passed away.
I have some cougars that have married younger guys,
that's
so
right.
that's a maybe you question it then.
What we did with this, I said, okay, first thing I want to do, I want to make sure you get the most income if that's your objective. They said, yep, income's really what it is. I said, okay. I looked through the thing. I said, wait a minute. Well, I can give you the same income, not any better. I said, nope, that's a decent number. And same exact income.
A lot of times they are.
And they go, well, why would I do this instead of that? I go, because you control the money.
That's right.
It's always your money. Like, right, if you take an income stream on a pension, if you and your wife or husband get hit by a bus, the money's gone.
You're gone, money's gone.
Let's say interest rates go up in 4 or 5 years right before you're going to retire. Well, you could negotiate a new rate, right? You can take this cash and do it. You can't do it with the other. If you take the pension, it is what it is. You're going to get that number, right? Now, also, that number is guaranteed by the company. How sure are you that they're still going to be around? And this happened to be a large company here in Dallas that I don't know if it's going to be around. It's been around a long time, but I never thought Montgomery Ward was going to go under it. You know, it's just something like that. So we took control of it. They got the same amount of income. Their heirs always get the balance. The money grows, which it doesn't really grow in a pension, right? It can grow up with the actual results they get from their general account or whatever, but none of that's, it's going to grow better. And let's say they start income and they want to go back to work. They can stop income. It'll increase in value again. So when they start again, the increase is even higher. Let's say 10 years into your retirement, interest rates go up to 10%. Well, get rid of the annuity, buy that. All of that is not possible with a pension. So that's what you want. If you can get the same income, sometimes I can get more. But
right.
If you get the same income, but you maintain total control of the money, that is way better than worrying about the company you used to work for to continue to pay to a certain level.
That's right. You got to worry. Remember Braniff and all the ones that had the issues.
Well, think of all the companies that have gone under that pensions have gone under. It's, I don't want to mess with it. Even though they have the Pension Benefit Guarantee Association, they got certain limits.
And these are good companies. We're not even talking about the Enrons and
these are great
the ones
companies
that cause problems. All right, well, we're not going to have a whole lot of time for stuff, but lately I've been hearing the talking heads on business talk about right now is a good time to buy the front end of the yield curve. And I figured, there's probably a lot of listeners, a lot of clients, a lot of potential clients that may not understand what that is. So take a moment here. We'll kind of take the mystery out of it for you if you're not familiar with it. The front end of the yield curve, what they're referring to are shorter dated maturities, 1 to 5 years. And then the back end of the yield curve would be considered 10 to 30 years. Now, the reason to play or to stay, there's several, but we'll start with the biggest reason. In the front end of the yield curve, meaning shorter maturities, 1 to 5 years, if we get to an inverted yield curve, we don't have that now. Inverted would be the opposite of what you would expect, meaning shorter maturities are paying you more, and if you tie your money up longer, you get paid less. That's inverted, right? Because it's not
normal yield curve. You pay more the longer you go out.
Yeah, the shorter terms pay less, and the longer you keep your money tied up, the more you get.
It's like a 6-month CD versus a 5-year CD.
Exactly. So inverted would be just the opposite. We're not there. When do inverted yield curves happen? What can cause them? Usually at the end of a market run, the long term or the back end of a yield curve will come down. If that happens, China's had this issue for a long time. If that happens, then it can become inverted. Why are they talking? Why do you hear them say, all right, well, I recommend playing the front end of the yield curve, and I'm going to stay there for a while? Well, what are we facing? What has the Fed told us the last couple of sessions? What did they do the last time they met?
Raised interest rates.
They raised interest rates. They've talked about it 3 or 4 times. Sometimes you hear someone say, I think they're going to do it 5 times this year, which is crazy. I hope, because it does put the brakes on the market, which we can talk about volatility too. There's lots of things right now. We'll get into the economy. A lot of good news there. But different things put the brakes on it. If Trump says something, our president says something, and everyone else, whether they believe it or not, says the sky is falling, what does that do? It puts the brakes on things. And the market tumbles a bunch. And then you wait and you see, and hopefully it's not that bad and things work out. And then everyone jumps in and the market recovers. So, and I've told my clients, Victor, I'm sure, what are you telling yours? But I tell them to hold on. I think the volatility is going to be here for quite a while.
It definitely will. But remember, the interest rates have an opposite effect to a bond.
Correct.
Interest rates go up, like they just said we're going to raise them. That makes bonds go down. The further you go out, the more that bond will go down. The lower the quality of bonds you have, the more it will go down. So you could have 20, 30-year bond fund lose 40% in value. But a short-term bond fund, let's say I've got a 2% bond.
And you normally think bonds are guaranteed.
Yeah, and I just got to hold it for 2 years. They're not going to fluctuate that much in the meantime. So that's why you want to stay. One of the big reasons you want to stay on the shorter end of the yield curve.
Because, like Victor said, if you have a 2 or 3 year deal, if you hold it for 2 to 3 years, whatever the term is, you are guaranteed. If you have a 30-year, you've got to hold it for 30 years for the guarantee to be in place, and everyone else may be making 6 or 7%, and you're locked in at 3 or 4.
And bond ladders don't work. They haven't worked since our yield curve flattened out years ago. Normally, you'd have some short-term, medium-term, and long-term.
Right.
And what you're getting is taking more risk on the long-term, but they're giving you more yield. The yield curve is so flat lately. It started to move up a little bit, but it's been flat for a long time. You weren't getting any more interest by going out 20 years than you were, 2 or 3 years. The laddering of bonds, you might have heard, I want to do a bond ladder.
They mature each year.
Some of your old school brokers, because they're still in that broker mindset, still do them. But I see no reason. If I'm not getting rewarded for going out there, why would I go out there? And so there's no – now, if it was – like say I was getting 1% on 1 to 5 years and I'm getting 10 on 10, oh yeah, bond ladder works really good because you can just ladder them out.
That's right.
But if I'm getting 1 and I'm getting 2 for 10 or 15 years, well, that's a pretty flat yield curve. That is not enough reward for the potential risk I'm taking.
Which is where the environment we're in right now.
That's right. Everything is risk reward. Everything. There's nothing wrong with stocks. I love stocks. I own stocks. I've been managing stocks for decades. I think the potential return is worth the risk at some times, as long as you do it right?
That's right.
But right now, bonds, that's why Ibbotson did his report. He goes, When Fed funds rate got to zero, bonds became a bad investment. Don't get me wrong, they stayed zero for a while, so you still made some money on bonds for those few years. But now that it's turned, bonds are a bad investment in a lot of ways, unless you stick with the short stuff.
That's right. And one of the things I also meant in referring to putting the brakes on the market as they raise rates, what happens when rates become attractive in bonds and in guaranteed investments? It now is in competition with your dollar for investment. Right now, or for the last several years, if you were seeking yield at all, you had to go to the stock market. It forces you into the stock market. Now, bonds, guaranteed investments become a little bit more competitive. Your dollar, there's competition for it. So it takes some of the money, and just supply and demand. It takes some of the money out of the market and you put it into bonds.
Well, think about it. We just know the market's made 5.27. Forget last year made 20-something. That was good.
Right.
But let's say the CDs are paying 6%. Besides there being a line at Bank of America from here to Houston, how many do you think some people are going to put more in CDs if it's 6%?
Absolutely.
Absolutely. It happens every time.
Couldn't handle the money.
And your bonds at that might be 7 or 8.
That's right.
And so that's a good time.
And if the yield curve's right, the further out you go, you are getting 7 or 8.
You can get that. It doesn't do it right away. But when that interest rates stop going up, and you can start getting that good bond ladder again where the yield curve goes up. In other words, the longer I go out, the higher the interest, or some of your CDs are paying 4 or 5, stuff like that. The only problem is I don't think you're ever going to get to those levels. 0 is too low, right? They had put it down to 0 to keep the economy going. Everything was crashing. But 0 is too low. There's a point in there that they're comfortable with, and it's only about 2 or 3%. So once you start getting above that on the short-term rates, they're going to stop it.
That's right.
Every time they got to a certain level, you see a CD the last 40 years get to 4 or 5%, they'll beat down the Fed funds rate 10 to 20 times each time they meet.
There's an argument for them not doing that, too.
Oh, yeah. Well, what happens is higher interest rates cool off an overheated economy.
That's right.
Because there comes less demand, so prices come down because they've gone crazy, right? A house has gone from 100,000 to a million, you got to cool it down.
That's right.
But, the Europeans, decades ago, they always messed with their interest rates. Their Fed Reserve was much tighter.
Where do you think we got the idea?
We got the idea from them.
That's right.
And since then, think about it. You haven't had that kind of crash that long. And a lot of it is because the interest rates, when real estate's down, but you can still get a mortgage for 3%, people are still buying real estate. You get those rates back up to 8 or 9%, trust me, people ain't going to be buying that much real estate because people don't buy the price of the house. They buy the payment. And the same house you're talking about could be double the payment.
Sure makes you think twice about paying off a 3%, 3.5% mortgage, doesn't it?
It does some way.
As the rates start climbing.
Now that you can only write off part of the interest.
That's right.
And it makes sense up to a certain value of a house, but after that, there's the taxes you can't write off. That's it's not the interest you can. Taxes are only $10,000.
10,000 limit.
Somebody needs to tell the people where I live that. Because my taxes are a lot more than that. Remember, I was talking the other day. Remember in the old days, you're like, I'm going to buy this house. And this is what you thought when you were younger. I'm going to live in there 30 years and be living for free the rest of my life because I own it.
That's right.
The problem is, by the time 30 years is up, the taxes and insurance are higher than your principal taxes and insurance when you started this whole mess.
That's right.
So that's what I tell people. Don't ever think you're not going to ever have a payment for housing. You always will. You'll start with one, and you'll die with one.
And I apologize. We're running out of time. I haven't been able to get through the economy. The unemployment is great. People are saving. People are spending. But we'll have to get to that next week.
No, absolutely. Remember, we offer a no-cost, no-obligation retirement analyzer, which is a written retirement plan that will stress test your portfolio. It is 10 times better than the ones you got online at the big brokerage firms. I can show you the differences, and there's no cost or no obligation. And we include a Social Security optimizer, and on top of that, at no charge. Call us at 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. I'm Victor McClure for Guy Allard. We always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment, product, or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.